The stock market is about to get shaken up once again because we're just a few short days away from the July Fed meeting. Almost 100% of all estimates say that the Fed is going to raise rates by 25 basis points, which is fancy for saying 0.25%, and that would bring us in a range of 5.25 to 5.5%. That's a very high Fed funds rate considering just a year ago we were at 1.75. So we're going to talk about what this means for the market. Do I think the Fed really is going to raise by that 25 basis points like everyone predicts, or are they going to do something different? And how is that going to affect the stock market? That's what we're going to get into in this video. But first, if you're new here, I'm Austin. Welcome. Thank you for being here. I'm a co-owner of CloudMusicSuite.com and I'm a stock market investor, of course. The channel's sitting around 900 subscribers right now. I'm not sure if we've hit that mark yet by the time I post this video, but if you're back and you are one of the subscribers, thank you so much. If you're new to the channel and you're not subscribed yet, go ahead and hit that subscribe button. And as a thank you for doing that, here's a picture of both my cats, Millie and Luna. Millie's the gray one, Luna's the brown one. They thank you for subscribing. Okay, so we're just a few days away from the Fed meeting, and they're probably going to come out and say, hey, we're going to go ahead and raise rates by 0.25 to bring us in a range of 5.25 to 5.5. That is a very high Fed funds rate, and what we want to make sure of is that we're staying away from really high debt companies in this time. Even if they come out and don't raise rates anymore, a 5 to 5.25% Fed funds rate is very high, and for companies that are debt loaded, we want to stay away from those in the stock market right now. But where are stocks going to move as a result of the Fed meeting, and what do I think the Fed is going to do? I do think the Fed's going to raise by that 0.25% in July, just to kind of put the nail in the coffin on the economy and try to prove that they've won the war. They really don't want to see the CPI and the PPI move up in any substantial way to get a second wave of inflation. Just last month in June, we had a huge CPI beat and a PPI beat. The PPI was expected to rise by 0.4%. That's the producer price index, but it only rose by 0.1%. And then the consumer price index was also a beat. So we've had multi-year lows on the CPI as it relates to year-over-year numbers at a 3%, and then month over month, it was a 0.2%. So it's getting more and more difficult for the Fed to raise rates more and more, and it's harder for investors to get on the side of the Fed when we have inflation dropping by that much based on the CPI and the PPI numbers that we've seen. The more months that we get of CPI dropping year over year, the closer we get to the Fed saying we're done raising and we're going to pause for now, we're going to put ourselves in a wait and see situation. If the Fed goes ahead and raises by 0.25 at the next Fed meeting, I think the market's going to go down maybe a little bit, but in general it's going to be flat. That rate hike is already priced into the market, and pretty much everyone believes that they're going to raise by 0.25. But what that means, if they don't raise, if they say we're going to pause for July and we're going to wait and see, I can see stocks moving up very nicely in the short term, continuing the bull rally that has started. And honestly, even if they do raise, I could see stocks moving up very nicely just because it's already baked in and we're kind of already started this bull rally. And it's almost like no bad news is the same as good news. On the other side of the coin, if two situations play out, I could see a lot of pain in the market over the coming months. One, if they raise by 0.25 and they signal for multiple more rate hikes in 2023, expect some big downside in the market. We would probably see a 5 to 10% drawdown in the indexes if they come out with that commentary. Even worse, if they don't raise by 0.25, but rather they raise by 0.5, expect some big downside. And if they raise by 0.5, they're probably going to signal for more rate hikes as we move through 2023. That would be evidence to me that they are absolutely just trying to destroy the economy. They're trying to destroy any hope out there for the stock market, and they're trying to stop this bull rally. The more they raise rates, the more strain this puts on debt-loaded companies and EPS negative companies, because EPS negative companies can't fund their operations from profits, and they can't fund expansion and investment into the business from profits because there are no profits. So as a stock market investor, what we need to really focus on right now is very well capitalized companies with very strong balance sheets, not a lot of debt, and a ton of cash ready to go. We also need to focus on free cash flow positive companies. Do not invest in a company without checking out that cash flow statement. And then lastly, we definitely want to see the majority of the companies that we're investing in to be EPS positive companies right now, or have an extremely short-term path that's extremely clear about how they're going to get to EPS positive within the next few quarters. If rates stay elevated for a substantial period of time and we don't hear about a rate cut coming, any money-losing company is going to continue to see weakness in the share price because their earnings are going to get hurt more and more by the higher interest rates on the debt that they have. That said, high interest rate times help us determine who can really weather the storm as a company and can help us make really informed investment decisions. If we see companies having worse and worse EPS in high rate times, that's going to let us know that they're probably not as recession proof as a company that can raise their EPS and raise their EPS guidance even through this tough rate environment. We've seen countless companies have a tough time as it relates to EPS, and then we've seen a decent handful of companies actually raising their EPS guidance, having earnings beats, EPS beats on a regular basis throughout this high rate environment time. We're going to want to go with the companies that can continue to raise their earnings quarter in and quarter out and post earnings beats quarter in and quarter out, even as we have these high rate times. Because imagine what they can do when there's no burden of the high rates. They're going to be a cash generating machine, and you can sleep well at night knowing if the economy goes to total garbage or if we get in a high rate environment situation, they're still going to prosper. So a lot of people see pain in this high rate time. I see a lot of opportunity, and it lets us get more of an insight into companies' financials and how they run their business and how strong they are and how recession proof they are as we see these hikes play out and the elevated rates stay there for a long time. I don't know how long rates are going to stay elevated, but I'd say at least a few quarters before they actually do a rate cut. So the way I'm positioning myself as we're moving into this next Fed meeting to find out if they're going to raise by 0.25 and all the commentary they have around it is super important as well. All I'm doing is keeping some cash on the sideline in case we get some negative commentary, in case they start talking about more than one more rate hike for the rest of 2023, or if they don't raise by 0.25 but they raise by 0.5, I want a little bit of cash on the sideline so that I can take advantage of the dip that we're going to inevitably have if the Fed comes in really hawkish and aggressive. I don't have a ton of cash on the sideline. I am heavily invested right now. I only have about 10% cash on the sideline because if the Fed comes in dovish and they're not aggressive and they're saying less rate hikes or even rate cuts potentially, or holding them steady for a wait and see situation, I want to take advantage of that upside in stocks. So it's not like I'm staying all the way on the sideline. I'm still somewhere around 90% invested, but I've also got a little bit of cash on the sideline just in case we have a little bit of a dip so I can pick up shares of companies that I think are going to prosper over the next few years as long-term investments. I want to hear what you have to say about this upcoming Fed meeting. Are they going to raise a lot? Are they going to come in hawkish? Are they going to come in dovish, aggressive, not aggressive? What do you think? And how are stocks going to respond? Lastly, what are you doing to prepare? Are you playing any call option plays, put option plays? Are you staying all in cash? Are you staying all invested, or just a little bit of cash? I want to hear about it. Let me know in the comments. Let's get some conversation, debate going on down there. That's one of my favorite parts of posting here on YouTube, is to see the comments and to get to interact with you guys. So let me hear about it down there. Thank you for being here and have an amazing day.